Up next, we have James Marple. He is the Managing Director, Senior Economist for TD Bank Group. Take it away, James.
Okay, thank you very much. Thank you for having me. A little bit different circumstance than past events. I hope to get back to Portland very soon and see you all in person. But in the meantime, hopefully we can have a good discussion about the impact of the virus on the Maine and U.S. economies. And I'll start that now. I have a bit of a PowerPoint presentation to go through, and hopefully it's useful. All right, so I'd like to take you through the economic outlook. We've called this presentation "Navigating Uncertainty," which I think is an appropriate title for any economic presentation, but perhaps even more so now, given the dependency of the outlook on some really uncertain outcomes with respect to the COVID-19 pandemic, with vaccinations, government supports. So just caveating that. A year ago, when we spoke last and talked about the economic outlook, we did not perceive the economy being thrown off track by the worst pandemic in 100 years. But here we are, and so we can just sort of follow the news as it comes in and relate those developments, and hopefully I have some good news for you on the outlook over the next year. So just to kind of sum it all up, obviously there's a bit of a tension in the economic outlook right now. On the one hand, we've had very good news on the rollout of vaccines. We're already vaccinating people around the country. 2 vaccines have been approved, and a third vaccine looks likely to join very shortly. So that's very good news. It of course will take time for that vaccine rollout to get us back to normal. And in the meantime, we have also seen a pretty significant rise in the number of new cases. And I'll talk a little bit about the impact of that on the near-term outlook. I also want to talk a little bit about some of the longer-term impact of the pandemic. Of course, we've seen a substantial policy response to the pandemic and to the economic crisis, and that has had implications for deficits and debt levels. The Federal Reserve has obviously acted to lower interest rates and do a combination of other asset purchases and lending programs to try to support growth. We've seen pretty substantial, obviously, shifts in where people work, and that has implications for real estate. The household savings rate has really been elevated by those income support programs I mentioned. We're following trends in the labor market, obviously, very closely, and looking for evidence of some of the second-order effects that usually follow from an economic recession, something to continue to watch for. And of course, finally, on a more global front, and I'll start with some of those comments on how the situation is transpiring globally, but we have seen sort of the virus exacerbate some of the trends we had been seeing in terms of deglobalization and nationalism. Even now, we see that with respect to the vaccines and where they will be distributed, but also with respect to supply chains and concerns that certain sectors like healthcare, we really maybe have some other considerations like security and having these things at home. So we'll talk a little bit more about that. Obviously, as I mentioned, this is really an economic outlook, an outlook for the future. Anyone talking about the future has to be a little bit of a versed in what's happening with respect to the health crisis. We're not epidemiologists as economists, but you have to at least sort of to follow the trends and just as important, the policy announcements in terms of lockdowns. This isn't an economy sort of driven by its traditional drivers as much as discrete actions of policymakers to try to avoid a further rise of the virus, and also to support the healthcare system. Good news in terms of the vaccines, as I already mentioned, that should allow for a faster pace of economic growth through the second half of this year. In the meantime, though, we really have seen the impact of this second and now third wave of the crisis. So looking at that from a more global perspective, Europe has been perhaps the most hardest hit region by the recent increase in virus cases. And in part that reflects their actions of governments to really shut down economies as the virus has spread in places like France and more recently in Germany, obviously in the UK, which has been hit by this more virulent version or mutation of the virus and has put its economy in outright lockdown. That increases the chance that before we get vaccines distributed, that those economies will shrink, and we're already seeing evidence of that in high frequency data, and that is being incorporated into near-term economic outlook. Lots of other things happening in Europe. There was fortunately a deal on Brexit between the EU and the UK at the last minute, but really I think in the near term swamped by obviously the news on the virus. China, which is where the virus originated, really was hit hard early in the year. And if we think back a year ago, we were sort of thinking about the impact of this virus as if it was some local phenomenon that would impact the rest of the world through global trade. We're obviously in a very different situation from that. But I think one thing that has surprised everyone is how swiftly the virus has both been contained in China and how quickly its economy has returned to positive growth. It has grown for now the latter half of 2020, not quite its growth rate that it was previously, but certainly given how much the virus has actually hit other countries even worse than China, it's grown in terms of its importance in the global economy, probably increased its share of global GDP by upwards of 1.5%. So fairly significant, and that just reflects the fact that it's actually outperformed relative to most people. And that's relevant to the United States, obviously, directly in terms of trade. China is being the biggest trading partner with the United States. And if we think back again to a year ago, the biggest theme for the economic outlook was finally reaching a phase one trade deal with China. That trade deal set very explicit targets on Chinese exports and imports from the United States, and in an effort to shrink the trade deficit with China. And I think it's just notable that those targets are nowhere near being achieved, and perhaps blown out of the water by the virus. But this is the situation that the new administration will inherit. And I think we can continue to expect that once this virus is over, there will continue to be trade irritants between China and the United States, and it will be a theme that we'll have to come back to in terms of how those impact the global economy. All that to say is it's not something that is going to go away anytime soon. So bringing it back home to the United States and to the main economy, this was the worst economic downturn and the swiftest, really, we've seen as long as we've been keeping good records of economic data. I mean, if you go back to the 19th century, you've seen sort of volatility like this. But the decline in economic activity in the first half of the year, about 10%. Decline in the first, a bounce back in the third quarter, growth returned positive, and we saw as lockdowns were ended, we saw a pretty substantial pace of growth. That growth looks to have slowed into the fourth quarter, and we think obviously will slow even more into the first quarter. But if we look at the level of GDP for the US, and this is something you should pay attention to, because this is a question I will pose and answer, but the question is, when will the US economy achieve its pre-crisis level of economic activity, of real GDP? And we expect that to be in the fourth quarter of this year, of 2021. So that means that we really, looking at from 2 years, really, from the fourth quarter of 2019 to the fourth quarter of 2021, just to get back to the level of GDP that we were at. It will probably be even longer. for the Maine economy, and that reflects a greater um, preponderance of service industries and of tourism that we expect to take a little bit longer to bounce back. So probably into 2022 before the level of economic activity has bounced back. But the good news is that the growth rate to achieve that level of economic activity will be elevated. And as I mentioned, I think once we can get past this initial phase of the virus that's really slowing economic activity, we should get a much faster pace of growth through the latter half of the year, dependent on vaccines being more widely distributed. So the variable that really I think has the most salience in terms of the economic crisis is the unemployment rate and what we've seen in the labor market. So I want to spend a little bit of time talking about that, both at the national level and for the Maine economy. Nationally, we saw a major rise in unemployment through March when lockdowns went into effect across the country. The national unemployment rate rose to almost 15%, which is way above where it was even in the 2008 financial crisis. Saw a similarly sharp increase in Maine. And in fact, the Maine unemployment rate has historically always been below the national unemployment rate. That continued, but still a very sharp increase. Now, there's two ways of looking at the unemployment rate. Obviously, to be unemployed, importantly, you have to be actively looking for work and participating in the labor market. And this crisis in particular, this has happened in past recessions, but in this crisis, due to the health crisis, a lot of people dropped out of the labor force. So in fact, the official unemployment rate actually understates the amount of people who are out of work. One way to quickly adjust for that is to leave the labor force where it was prior to the recession. And if you do that, you see that nationally the unemployment rate was almost 19 or around 19%, and in Maine around 15%, the 15% that we saw nationally. That we saw nationally. Pardon me. That has seen pretty consistent improvement, and importantly, we have seen that come down, still elevated relative to where it was, but we've made some progress now. I want to talk a little bit about the outlook, but first, again, I think important to talk a little bit under the surface about how this recession has hit the labor market. And as we know, it's really something that has hit service industries and tourism-related businesses much harder than professional businesses, people who are able to work from home. And due to a higher share of those businesses in the Maine economy, and especially as a share of employment, we have seen a disproportionate impact on lower wage workers that have seen, and this is true nationally, but even more so in Maine, and that has resulted in a greater loss of jobs there, and exacerbating some of the the underlying inequalities that were already evident in the economy. And that is also something I think noteworthy in terms of stimulus and income support programs, which have fortunately gone a long way to counteract some of the specific impact of this virus on workers. One thing we're increasingly concerned about is initially you saw that the most of the rise in unemployment was temporary, and people were temporarily laid off. But as we've seen the period of lockdowns and just depressed economic activity go on, we've seen increasingly more of that. Those job losses have become permanent, and that's something that we will be watching for even going forward, because that's the kind of thing that prolongs the return to normal. Obviously, is a sign that as much as supports have helped, there are people who will have a harder time getting back to work, and more businesses that will have a harder time operating, and that really is a bit of a fly in the ointment to an otherwise I think pretty good economic outlook going forward. Now, just looking at something that I think is actually particularly interesting to the real estate market, and that's the fact that you have seen a difference in the number of jobs lost to businesses operating in a particular jurisdiction, and in this case, I mean specifically within Maine, and the number of jobs lost among people living in the state. And this is something that has happened in past recessions, but I think in this crisis also we have a situation where people are even moving to places outside of major cities in order who are able to work from home. That is something that I think will continue past the crisis. So I just wanted to show that, you know, there's quite a gap between jobs lost among businesses, and again, that reflects, I think, a lot of businesses serving tourism and other sectors of the economy where people are coming into the state, but people coming in to work haven't been as bad, and we've seen consistent improvement there. There's a bit of volatility in these numbers in terms of the household survey, but I think a good sign that that's shown more consistent improvement. Now, so in terms of again coming back to the near-term outlook, obviously the virus now, you know, the second wave pales in comparison to the third wave, and in fact, within Maine, there really wasn't much of a second wave. So this really is now the second wave of the virus, and we're tracking on a daily basis the number of new cases, and this is something obviously that health authorities are watching very carefully, and important because, you know, these kind of thresholds are when you see stricter lockdowns come into effect, especially in populations more vulnerable, older populations such as in Maine. And we have seen that show up pretty directly in terms of economic activity. So we had been surprised earlier in the year with the pace at which situation had normalized. In fact, the index of leading economic indicators that relies on both traditional economic indicators like payrolls and building permits and you know, real estate prices, but also adding in things like Google mobility data on where people are traveling to place of work and retail outlets. And you put those together and you saw actually a pretty strong rebound through the summer months. But that has really deteriorated later in this year as the virus has risen, and so really confirms that story that in the very near term we are looking at a softer economic environment. Now, due to just the way the monthly pattern has worked, that's probably going to show up most in the third quarter, and we don't have data on fourth quarter GDP. By fourth quarter, I mean, you know, to December at a national or state level. I would guess by that last chart that actually Maine's economy may be harder hit in the fourth quarter of last year, but we expect to see that show up in a pretty soft pace of growth, and that's reflected in analyst estimates of growth. What I'm showing here on this chart is a median estimate among economists who participate in a survey for US growth, and we've really seen expectations for Q1 growth fall, even as they remain pretty resilient for Q4, in part just reflecting better data at the beginning of the quarter than we've seen through the end of the year. So as I already, I think, mentioned, I mean, one is unprecedented as the economic decline has been, equally unprecedented has been the scope of the policy response, and really swift in terms of the CARES Act getting income supports to people, both direct $1,200 checks initially, and I'm thinking back to what happened in the early summer and spring of last year, and that's actually kind of unique even among other countries. Only Canada has had a more generous income support program, and that was very important in terms of actually, I think, contributing to that faster than expected rebound in economic activity. And we've seen that we've now seen that those have declined in terms of the supports ending, but we just got a deal to increase those supports, both $600 checks to individuals, and of course the increase, and just as important and perhaps even more important for vulnerable households who are have lost jobs, the top up and extension of unemployment benefits of $300 per week that will continue through the first quarter of this year. And as a result of those, we will see income that will maintain. In fact, I don't show the first quarter of 2021 here, but there will be a big jump in personal income. The distribution of the second round of checks is expected to be even faster than the first round, because the machinery is already in place, and the IRS, pardon me, is already sending those checks out. So that will really give a big boost to income in the first quarter, and I think go a long way to mitigating some of the downside risks over the medium term, and allow the economic recovery to continue, given what we've seen in terms of the necessary lockdowns to prevent the further spread of the virus. Pardon me. So one area of the economy that has really outperformed, I think, anyone's expectations is the housing market. And we've seen that show up in terms of sales, in terms of prices, and in terms of construction. What I'm showing here on this chart is housing permits in Maine, and we can see that they've really grown like gangbusters over the last year, the highest level we've seen in quite a long time, and that's been mainly single-family homes. And really two factors behind that. One, as interest rates have fallen, we have seen demand across the country that has really grown. Job losses, as I mentioned, if you're a professional, there's a large segment of the population that is better off in some sense than they were prior to the crisis. They've kept their jobs. Many people have received additional income supports, and they're looking for a bit bigger space. Maybe they're looking for something that they can go to a vacation home, which are an important part of construction, obviously in Maine, and that all together has combined to really lead to a very strong housing market, and something that I think may have some legs. I mean, certainly an initial burst of activity, but interest rates are likely to remain fairly low. I'll talk a little bit more about the interest rate outlook, which is as I close, but also just in terms of changes to demand, and the fact that there probably will be a segment of the population that will increasingly work from home, and maybe have to go into the office once in a while, but enough that they can have a longer commute, that they can have a little more space, that they can live in a jurisdiction with a lower cost of living. And I think that's something that is one of those secular trends that will be obviously very important to watch, and has direct implications for the real estate market in Maine, where I think that kind of demand will continue at least for some time. Okay. So now, in terms of the interest rate outlook, I want to talk about it from a couple of different angles, but certainly we expect to see that interest rates will remain pretty low for some time, and there are obviously risks around that on both sides. But one reason for that is just the amount of debt that we've seen, and I'll show that slide again. But it really does require interest rates to remain low in order to keep debt levels sustainable. And it's sort of it's a bit of an inverse relationship, but you do see that if interest rates were to increase relatively quickly, that would have a dampening effect on economic activity in a way that almost requires interest rates to stay low pretty indefinitely, just to maintain economic progress. And certainly financial conditions are something the Federal Reserve watches very closely, and they're looking at it from the point of view of something that if we were to see interest rates increase, I think we would see pressure on the economy in a way they would try to avoid. And just to bring that home, we have already had seen debt levels, pardon me, that were rising to an unprecedented level. A big jump through the 2008 financial crisis, but we have seen that even higher due to COVID-19. We expect to see some stabilization in both in the U.S. and other advanced economies as economic growth returns, and some of this is the increase in spending, and some of it is the drop in economic activity because this is related to GDP. But that is something that is really going to last. High debt levels will be a factor, especially public debt levels, which of course increases some vulnerabilities down the road, and something that we'll have to continue to pay attention to in terms of longer term economic risks. The other factor, though, that I think is important in terms of interest rates is the fact that the Federal Reserve has told us that they are going to leave interest rates low for a very long period of time. And they actually have changed the way that they think about their inflation mandate, and they've told us that they will leave rates on hold until inflation returns to average a 2% over some period of time longer than a year, could be 1 or 2 or 3 years. And we know that over the past several years, inflation has undershot that 2% target. So that would allow inflation to get above 2% for a period of time before they feel that they have to raise interest rates. Our forecast, as is shown here, and again, this is a question and answer here that you may want to pay attention to, but when do we expect interest rates to the first liftoff from the Federal Reserve, the first increase in interest rates, and that is not expected to happen until 2024, as you see in this chart, the first quarter of 2024, and so that is in part because of the communication that the Fed has given that they will allow inflation to overshoot. Now, I would say the risks around this do depend on the inflation outlook. The Fed will tolerate perhaps inflation rising above its 2% mark, but only so far. And if we are to see that as the economy rebounds and people return to normal, some of the shocks to the supply side of the economy and supply chains, and the need to localize more supply chains, and even just to operate with greater safety protocols and all of those kind of things, which I think are hard to measure in real time, but there certainly is a story that we could see inflation pick up, that is what would be the factor that may lead the Fed, if it is committed, and we believe it is, to maintaining stable inflation over the medium term, that would cause them to have to raise rates earlier, and as it always is, something to continue to watch for quite closely. Now, I just want to close on what I think is actually a pretty good news story for the Maine economy, and that's the fact that if you've seen in me or other economists speak about the outlook for Maine, obviously demographic considerations are very high on the list. Maine's population has up to relatively recently been shrinking, and one of the oldest population in the United States. So people, the birth rate is lower than the death rate. Hard to say that without sounding a bit morbid, but so population growth entirely dependent on bringing people in from other parts of the world and other parts of the country. And the good news is that the recent data from the Census Bureau estimates are that there have been increasingly people moving into Maine, and the population growth has turned positive for the past 4 years. I think that's really a very positive development. But that's not to say that there aren't challenges in terms of an aging population, and the fact that even with that influx of people, core working age people, 15 to 64, that population is still declining, whereas the population of people over 65, as boomers continue to age into that age group, is continued to grow faster than it ever has historically, which obviously has important implications for healthcare and challenges faced for local government finances. But but also for just the ability of the economy to grow and the need for workers. So bringing in younger people, I think, will continue to be the challenge, and will be the opportunity potentially for further growth in the Maine economy once we get through this health crisis. And that concludes my economic outlook. Thank you very much for the opportunity to present this to the MEREDA conference. I hope that next year I can do it in person. Thank you.
Thank you so much, James. That was really, really interesting. And I love charts and graphs, numbers. I know everybody here shows up to hear what's happening, and a lot of great charts for us to follow along with.
Yeah, I got to say, I don't know that I always understand everything they're going over, but I love listening to economists. They have a great way of just explaining all these things and these numbers and all these trends. And I think then you just got to break it down to what's really going on. I think there are a number of trends he talked about, including in real estate, how across the country you've seen a housing boom. People are buying houses and through this pandemic, and it'll be interesting later this afternoon when Dava talks about all that and see if that trend continued here.
Yeah, I agree. I mean, we all have the sense that it's been hot, so it'll be interesting to find out what she says. One of the things I really liked from a positive note, because there's all this negative stuff going on, is that we hear that public policy is really supporting us here in Maine. It was higher than the average, the national average, which I felt like that was a good thing too.
Yeah, and and the other thing he got to is, things are a little tough right now, definitely true, but he sees us getting back to pre-recessionary levels by the fourth quarter of this year. So there is some light at the end of the tunnel.
Yeah, I think there is. I think that we have a lot of great people moving here. I think that the population is trending upward. That's really positive for all of us investing our time in growing the state of Maine and not planning to leave.
And you know what I didn't understand? I'll never understand this stuff, but the Federal Reserve, for those of you who are in the question mode, there's a question when the Federal Reserve will be changing their rates, and they won't do so for 2024. Why does that happen? I don't understand that, but I guess that's their thing to do.
I think that's why we need economists, frankly.
That is exactly why we need economists, yes.